Ashwini Agarwal joins us. Let's connect with him, understand what his current market view is, where is he investing, and what does he make of what's happening in terms of this entire Adani Group of stocks and the news there. Ashwini, good morning. Thank you for joining us. It's a new
Morning,
backdrop.
Nikunj.
You're not joining us from your office?
Yes.
No, I'm saying it's a new place. Looks like you're joining us from.
Yeah, this is my office. This is my office that I recently opened at Kohinoor Square in Dadar.
Okay, congratulations.
Thank you.
Uh, it's been a hard year to call. Lot of news, lot of views. What do you make of the volume, the news flow, and the market action so far for this year?
So I think, we started off the year with negative news flow on foreign flows. Basically, India was the only game in town through 2022. And at the start of the year, we started to see other emerging markets look more attractive, which kind of continued the pressure on foreign selling, which was visible for much of 22 as well, except for the last quarter or so. And then we saw that resume at the start of the year. And then, of course, you had the episode of the Hindenburg report on Adani Group, which caused a massive risk off in terms of sentiment insofar as India is concerned. So these two events combined, plus the fact that India's demand is slowing down, earnings growth is kind of ho hum, didn't really leave any room for excitement. So that kind of caused the sort of weak sentiment and lack of interest among market participants over the last 2.5 months. As we look forward into the rest of the year, the way I think about it is that hopefully at some point in time during the year, we'll start to see an end of the rate hiking cycle that we've been into over the last year or so. And hopefully with growth expectations also moderating, we will get into the situation where growth starts to meet expectations in terms of earnings growth. And the extraordinary amount of capital expenditure that the government is putting into the ground starts to have a knock-on effect on aggregate demand. So that's what I'm hoping to see as the year goes forward. But obviously, it's been kind of a very, very not difficult, I would say, but very lackluster year so far.
In your understanding, do you think the impact what markets had when they were feeling the heat because of the sell-off in Adani Group of stocks, whether it was infra names or lenders or NBFCs, is that behind us? Is that price adjustment behind us?
Yes, I think so. I think the whole episode, which led to the sell-off in the banks and weakness in the sentiment, is now behind us. Partly because I think, all the financial companies and banks that are lenders to the group kept reiterating that at least insofar as the operating companies are concerned, the operating cash flows are sufficient to cover the debt. Now, I'm not invested in any of these companies, so I don't have any first-hand knowledge on what the indebtedness, etc., looks like. But if I accept that at face value, and then you look at the GQG transaction that happened last week, it appears that at least for the moment, the group has enough cash flows to be able to meet its obligations. Whether in the near term we will see more sell down from them or any specific asset sales, hard to tell. But I would imagine that given the steep fall in stock prices of the group and given the cash raise that happened last week, insofar as the market is concerned, this is no longer an overhang. That would be my take.
But Ashwini, just wanted to understand whether the Adani saga episode has sort of put a new lens to leveraged groups in the market. I mean, without naming a few, is the market now going to be circumspect of highly leveraged balance sheets?
Aisha, that's been the case for the last 10 years. I mean, since you brought this up, and I was just reading this morning an article on the appointment of Ashish Gupta as the CIO of Axis Mutual Fund and how he shot to fame with his House of Debt report in 2012. If you go back over the last decade, debt has been a dirty word pretty much all through. And I think the market has been very, very careful about investing in companies which have a lot of debt. So I don't think there's an incremental change to that perception. And I wouldn't say that over the last two years or so of the rally that we saw post-COVID, that the market became a little bit cavalier in terms of how it looked at debt-oriented companies. So I don't think there's a change there, frankly.
A lot of analyst reports have also come out, which are now talking about, okay, banks, great sector to be in. The best perhaps is behind us because interest rates are high, NIMs will come under pressure, and peak of the profitability is behind us. Do you think best of the run-up in banks is over?
Great question, Nikunj, because I've been wondering about that too. But let's take the three pieces that you spoke about. Let's first talk about rates going up and NIMs. Insofar as the results for the December quarter are concerned, there is no pressure on NIMs. And if you look at the outlook that has been presented by most of the banks after the December quarter results, they do not indicate any pressure on NIMs either. Bulk of the loan book is floating in nature, and some of the FDs are kind of fixed in nature. So in a rising rate cycle, the near-term NIMs don't see much of a pressure. That's obviously evident in the numbers that we see in the December quarter, and that's coming through in the commentary for the March quarter as well. So I don't think NIMs are going to be under pressure right now. In terms of credit costs, yes, you're right. In terms of operating expenses and credit costs, a lot of the good work done over the last 4-5 years is now finally showing through for the last 3 or 4 quarters. But my sense is that write-backs are still not in. And that may be a source of positive earnings surprises as we go ahead. There is a lot of chatter about difficult resolutions, making some headway. So let's hope and see what comes through. So putting this together, is the best of the rally in the banks is done? The answer probably percentage terms is yes. But will you see more upside in the banks? My take would be yes. You will see more upside because I think the earnings growth is still going to be quite robust. Balance sheets are starting to grow. So you're seeing loans growth in mid-teens for most of the banks. So earnings growth is going to be very, very good. And if you look at long-term valuations, many of the banks are still trading at below median valuations from a long-term historical perspective. And one of the things that I've kind of figured out over a period of time, or at least that's what I think, is that no sector tops out till it starts trading well above the median. In terms of valuation. So I don't think the valuations are excessive just yet. So that's what gives me hope. But yeah, you're right. You're not going to see multi-baggers from here. But will you see still some price action? And is this still a good place to invest in? And I think so.
Ashwini, morning. Wanted to get in your take on the telecom space as a whole because yes, we are seeing a lot of faster data, a lot more mobile penetration. What about some of the headwinds for these companies like reduced profitability or high debt? Is that a concern?
Not to my mind. I mean, I think the stability in market shares between the two leading players and the small steps being taken to raise prices at the bottom of the pyramid, the rollout of the 5G services, which obviously will lead to a switchover at the top end of the pyramid. These are all factors that should help earnings as we go along. Also, I mean, I'm just thinking and reading about the news reports where the regulator is talking about OTT players having to share some of the revenues with the telcos. I don't know what will finally come through. But it can be something better than zero, which is the case right now. So that might be another leg up. So it's a consistent earnings growth story, and valuations are kind of okay. They're not super expensive. So I'm hoping that there is a little more legroom here for the stock prices to move.
Ashwini, what about infrastructure? Because, anyone and everyone that you speak with is definitely bullish on this space. Is it now getting to that overcrowded trade, or do you think valuations are still pretty lucrative?
Infrastructure is a difficult one. If you look at construction companies and, provider of infrastructure services, I mean, this is a deeply cyclical business with huge payment issues and receivables in the past. So I'm kind of very wary to invest in this area. Insofar as infrastructure owners are concerned, again, if you go back in history and see how many of them have made money for investors on a consistent basis, the answers are very, very difficult. Yes, it's a growth area which is driven by government investment, and hopefully it will drive the economy. But does it mean that the stock market will make you money because of infrastructure? Probably not directly, maybe indirectly through machinery manufacturers and overall aggregate demand picking up. That would be the way I would look at it. I'm kind of staying away from the infrastructure space by and large.
All right, appreciate your time. Thanks so much for joining in and sharing with us your
Thank you.
thoughts on the markets. Just